Hello everyone, my name is Michael, and in the last week, the S&P 500 dropped over 2% as fears of a new COVID-19 variant spread. And it wasn't just the S&P 500 where we saw a decline. There were also drops in cryptocurrency as well. This drop wasn't as bad as we've seen in the past. I'm not saying that 2% isn't steep for the S&P 500, but just know that it could have been a lot worse. But for this video, let's throw that 2% drop to the side for a moment. And whether you have a 5%, 10%, 20%, even a 30% or more drop in an index like the S&P 500, is there anything you can do to safeguard your investments and your capital to ensure that even when COVID-19 happens or the housing market collapses, are you still able to come out positive by year's end? The answer is yes. And there are a few things you can do. I want to go over an investment strategy that is known to give a positive annualized return even when things get really bad. And by the way, this is not the end-all be-all of investment strategies. There are other strategies out there to ensure you have a positive return. Like with the S&P 500, it has never produced a negative annualized return, which tells us that the S&P 500 index does recover. Sometimes it takes longer from one event to another, but if you just wait, you will not be negative in your returns. The difference between that and what I will go over is that this investment strategy includes more than one asset. It is diversified, which lowers the risk that is present when things start looking bleak. This investment strategy is called the all-weather portfolio, meaning that this is a portfolio designed to withstand turbulent times and still come out positive. This is a portfolio that was designed by Ray Dalio. He is a billionaire hedge fund manager, and he designed this portfolio to feature a few different types of assets. These different assets are equities, commodities, and bonds. For reference, this is considered a medium risk portfolio, and it can be replicated with 5 different ETFs, which I will go over. In the last 10 years, this portfolio has achieved a 7.18% annualized return and a 7.98% annualized return in the last 25 years. In 2020, this portfolio granted a 1.4% dividend yield, which does help with the returns. The first component that I want to go over are the equities in this portfolio. 30% of this portfolio is dedicated to equities, and the key behind this component is that this is a large cap ETF, and it is the Vanguard Total Stock Market ETF with ticker VTI. This ETF is a basket of all large, mid, and small cap companies in the United States. This is an index with thousands of different positions, which means that the industries represented in this ETF are very diverse. This ETF has an expense ratio of 0.03%, so for every $10,000 invested in this ETF, $3 will be deducted or priced in, which is very low as far as expense ratios will go. The next two components to this portfolio are bonds. Bonds are very low risk. They do not grow in value as much as equities, but when things get turbulent, these are very stable and predictable assets that will not be affected as much as equities would when a market crash happens. There are 2 different types of bonds for this portfolio. The iShares 20+ year Treasury bond with ticker TLT and the iShares 3 to 7 year Treasury bond with ticker IEI. The recommended weight for TLT is 40% and for IEI it is 15%. You can think of TLT as a long-term bond, and you can think of IEI as an intermediate term bond. The expense ratio for both TLT and IEI is 0.15%. The last 2 components to this portfolio are commodity trust. They are weighted equally at 7.5%, but they have different representations. The first trust is based off of precious metals, and it is the SPDR Gold Trust with ticker GLD. The second trust is much more broad and diversified, and it is the iShares S&P GSCI Commodity Index Trust with ticker GSG. The idea behind these trusts is that you are investing in commodities. Think precious metals, oil, and more. One of these is the equivalent of investing in gold, which is commonly believed to be a hedge against inflation. GLD has an expense ratio of 0.4%, and GSG has an expense ratio of 0.75%. So unlike the Vanguard Total Stock Market ETF, there will be significantly more capital deducted or priced in to participate in this ETF. If you do go with this portfolio as it is designed, you will be paying a total expense ratio of 1.48%. So for every $10,000 invested with this portfolio, there will be $148 deducted or priced in. So it is quite a bit for an overall expense ratio, but the selling point for this portfolio is that it is stable across all seasons of investing. So that may be worth it for you to pursue this portfolio. That is it for this video, everyone. Let me know down below if you would invest in this portfolio, or if there is another portfolio you would use to protect your capital when things look bleak in the markets. Thank you so much for watching.